Are you an executive who's watched their 401k company stock drop 30, 40, 50% or more? Or maybe it hasn't dropped yet, but it could. Either way, keep watching. A sharp decline can feel like a disaster, but the counterintuitive truth, it could create a tax opportunity worth hundreds of thousands, but it won't last forever. When your 401k company stock takes a major hit, it's painful. But here's what many executives miss. That decline may have just opened the door to a powerful tax strategy, one that could dramatically reduce your future tax bill. Not recognizing this opportunity, that's 401k critical mistake number 6. Hi, I'm David Dunn, a CPA, wealth, and tax strategist, and the founder of David Dunn Wealth. For over 30 years, I've helped technology and aerospace executives navigate the complexities of their wealth, from optimizing their 401k and RSUs to managing executive compensation and tax strategy, including complex strategies like Net Unrealized Appreciation. Throughout my career, I kept seeing executives make the same costly mistakes. That's why I created the Critical Mistakes series, my signature educational platform designed to help executives avoid critical mistakes, some costly, others irreversible. 401k critical mistake number 6 is not evaluating whether selling 401k company stock at a loss and immediately buying it back could dramatically lower your future tax bill. I know, it sounds counterintuitive. How could selling at a loss save hundreds of thousands? Here's why it can work. The answer is a 3-letter tax strategy called NUA, or Net Unrealized Appreciation. Let's say you have $6 million of company stock inside your 401k. You originally paid $3 million to buy that stock. That $3 million, that's called your cost basis. Because the stock has grown from $3 million to $6 million, you have $3 million in gains. But here's what executives often do. They roll over their 401k to an IRA. If you roll that $6 million into an IRA and withdraw it later, you'll pay ordinary income tax on that entire amount. If you're in the top income tax bracket, you'll pay a 37% tax. That's $2,220,000. But with the NUA strategy, here's what could happen. You could potentially pay ordinary income tax on just your $3 million cost basis and the much lower capital gains tax on the $3 million in gains. Tax on the cost basis, $3 million at 37%, that's $1,110,000. Tax on the gains, $3 million at 20%, that's $600,000. The total, $1,710,000. The savings compared to rolling it to an IRA and withdrawing it all, $510,000. Here's when you'll pay each tax. You'll pay the $1,110,000 ordinary income tax on your cost basis when you distribute the stock from your 401k. But the capital gains tax, you'll pay that when you eventually sell, and it's based on whatever the stock is worth when you sell it. In this example, if you sell at $6 million, the capital gains tax on that $3 million gain would be $600,000. Additional federal and state taxes may apply depending on your situation. So, when could this reset strategy work, and when might it backfire? Meet Lisa, age 60, an executive whose company stock just dropped sharply. Lisa's tax situation, 37% ordinary income tax rate, 20% long-term capital gains tax rate. Lisa originally paid $3 million for the company's stock in her 401k. So $3 million is her cost basis. The stock grew to $6 million. Then it dropped 70% to $1.8 million, well below her $3 million cost basis. If Lisa sells at 1.8 million and then immediately buys back at 1.8 million, her cost basis drops from 3 million to 1.8 million. This $1.2 million reduction in cost basis could become critical. Why? Because the lower her cost basis, the more future growth could be taxed at long-term capital gains tax rates rather than the usually higher ordinary income tax rates. If the stock recovers and grows, that difference could save her hundreds of thousands in taxes. How much exactly? $204,000 in additional savings when the stock is eventually sold, just from the reset. Let's look at when this can backfire. Lisa originally paid $500,000 for her 401k company stock. That's her cost basis. The stock grew to $6 million. Then it dropped 50% to $3 million. But she's sitting on a $2.5 million gain. If Lisa sells her company stock for $3 million and buys it back at $3 million, her cost basis jumps from $500,000 to $3 million. That's the opposite of what she wants. In this scenario, selling the stock and buying it back after a big decline makes things worse, not better. $425,000 in additional taxes when the stock is eventually sold, just from this mistake. How do you know if selling your 401k company stock and immediately buying it right back will help you or hurt you? It comes down to one question. Is your stock currently sitting at a gain or a loss? If your stock is below what you originally paid, selling and repurchasing could lower your cost basis. That helps. More gains could be taxed at capital gains tax rates instead of ordinary income tax rates. If your stock drops but is still above what you originally paid, selling and repurchasing could raise your tax basis. That hurts. The good news? Because 401k transactions aren't taxable events, wash sale rules generally don't create issues inside your 401k. You can sell at a loss and immediately buy it back, and your cost basis resets for NUA purposes. Most investors can't do this, but inside a 401k, generally, you can. Here's the key. The cost basis reset only creates value when combined with the NUA strategy. The net unrealized appreciation strategy requires specific steps and precise timing. Get one detail wrong, and the IRS could disallow the entire strategy. Here's what typically needs to happen. First, you need to qualify. There has to be what's called a triggering event. Second, you'll typically move everything in your 401k that's not company stock to a new IRA through a direct rollover. Third, the company stock itself gets transferred in certificate form to a taxable brokerage account, not your IRA. Fourth, these transactions must meet the IRS definition of a lump sum distribution. And fifth, you need to complete everything so that your 401k balance hits zero by December 31st of the same year. Your specific situation may require different steps. This is where working with a qualified advisor becomes critical. Here's what to do right now. First, determine your gain or loss. Is your 401k company stock below what you originally paid? If yes, a reset could help. But if it's still above what you originally paid, a reset can hurt you. Second, if the reset makes sense, work with a qualified advisor, one who truly understands NUA. They can run the analysis, evaluate if this could lower your future tax bill, and execute it with the precision NUA requires. And third, what if your 401k company stock hasn't declined yet? Learn this now. Sharp declines happen fast. You need to know what to do the moment it occurs. Here's the counterintuitive truth. A sharp decline in your 401k company stock, bad for your balance, potentially great for your taxes. If you know how to reset your cost basis and you combine it with the right NUA strategy, what looks like a loss can become an opportunity. But this window doesn't stay open. If your stock recovers, the opportunity closes. In over 30 years, I've rarely seen executives use this strategy. Don't let this window close on you. Let's explore working together. Schedule a complimentary 30-minute consultation at daviddunn.com. You can also subscribe to my complimentary email newsletter for insights from the Critical Mistakes series, and follow me on LinkedIn, YouTube, and Instagram. If this video opened your eyes to a strategy you didn't know existed, please like it, subscribe, and share it with others. This is 401k Critical Mistake number 6, one of 4 videos covering some of the most costly mistakes executives make with their 401k company stock. Each one could cost you hundreds of thousands. Be sure to watch 401k Critical Mistake number 3, 401k Critical Mistake number 4, and 401k Critical Mistake number 5. Keep watching the Critical Mistakes series. Each one is critical.